DPC Holdings, ticker DPC, just missed consensus on the bottom line for their Q2 2026 report, but they absolutely crushed the top line. Adjusted EPS came in at 5 cents.
Right, which missed the 8-cent estimate by a trim 3 cents.
Yeah. But that revenue, it landed at a record $268.7 million.
Whereas a massive $22.7 million beat. And management actually came right out of the gate and initiated their full year 2026 guidance.
Oh, right. Setting expectations for what, $1 billion to $1.04 billion in revenue?
Exactly. And $182 million to $187 million in adjusted EBITDA. But, the stock reaction following those numbers was just a severe roller coaster.
It really was. I mean, shares popped 6% in the pre-market, hitting 54.59 on the back of that huge revenue beat.
Yeah, but then they ultimately closed down nearly 4% at 50.22.
Because reality set in on their cash flow.
Precisely.
So our mission for you today is to cut through all of that volatility. We are digging through DPC's Q2 earnings report, the 10Q filing, the earnings call transcript, and the latest Wall Street analyst notes.
Yep, the whole stack.
We need to uncover exactly why a record-breaking, guidance-raising revenue quarter resulted in a brutal stock sell-off. We want to give you, the retail investor, the actionable intel required to understand what the institutional algorithms are actually reacting to here.
I mean, it is the classic post-IPO paradox. You have this explosive top-line growth colliding head-on with the very messy, cash-intensive reality of scaling up physical manufacturing operations.
Right.
To really understand why the market reacted with such whiplash, we have to bypass the headline panic, tear apart the income statement, and really look at where this growth is originating.
Well, let's start with the top line, because a 33.7% year-over-year revenue surge is just monstrous for a heavy manufacturing company.
Oh, absolutely.
We are not talking about a software startup scaling user licenses with zero marginal cost here. DPC is forging physical, highly engineered metal parts. So where exactly is this tidal wave of sales coming from?
The growth is really being driven by two primary end markets that are both experiencing significant structural supercycles right now.
Okay, so what are they?
First, you have the aerospace segment, which saw 47% growth year over year.
Wow.
Yeah. And second, you have industrial gas turbines, or IGT, which grew by 42%.
That's massive.
It is. When you roll those two divisions into their broader engine products segment, revenue grew 39% overall. And we also saw incredible geographic strength.
Right, I saw that, a 49% revenue jump in Europe.
Exactly, and 29% in North America. I mean, this is a global acceleration in demand for precision castings and superalloys.
Okay, so you're painting this picture of an unstoppable structural supercycle. But, I mean, I'm looking at the bottom line of the Q2 report and seeing a staggering $131.1 million GAAP net loss.
Yeah, that number is definitely shocking at first glance.
Right. If demand is so incredible that sales are up nearly 34% globally, how on earth are they losing almost 49 cents on every single dollar they make?
It's a fair question.
Because that math simply doesn't add up for a successful manufacturing business.
It looks terrifying on the surface, but this is where we really have to strip out the accounting noise for you listening. That GAAP net loss is heavily skewed by the simple fact that DPC just executed its initial public offering in June.
Okay.
When a private company goes public, it triggers a massive cascade of one-time, non-operational accounting events.
So it's just the financial plumbing of simply becoming a publicly traded entity.
Exactly. That $131 million loss includes a very large accrual for a management incentive plan, the banking fees, the legal expenses of the IPO roadshow itself.
Which are never cheap.
No, not at all. And a brand new incentive share scheme for employees. Under generally accepted accounting principles, you are forced to recognize those costs immediately on the income statement.
So they hit all at once.
Right. However, those are not recurring cash costs related to, actually forging and selling turbine blades. If you want to measure how the actual manufacturing business is performing, you have to look at adjusted EBITDA.
Because that metric strips out the one-time IPO bonuses and all that financial structuring to show you the core operating profit.
When you isolate that operating performance, adjusted EBITDA actually rose 33% to $48 million.
Oh, wow.
Furthermore, they held a very healthy 17.8% adjusted EBITDA margin.
That's really strong.
It is. Operationally, the core business is highly profitable and growing its earnings right in step with its record revenue.
Okay, that context completely changes the picture. It's almost like buying a new house and checking your net worth the day after you pay all the closing costs, the broker fees, the transfer taxes.
That is a perfect analogy.
You look completely broke on paper for a minute, but your actual earning power in a day job hasn't changed at all.
Exactly.
Though scanning through the segment data, there is one obvious weak spot, the Turbo Wheels division.
Yes, the laggard of the quarter. Adjusted EBITDA for Turbo Wheels fell to just $2 million.
Which is pretty steep.
It is, but even that comes with a significant asterisk. A large portion of that segment is a legacy business called Ivostud, which management is actively marketing for sale right now.
Oh, I see.
When a corporate division is put on the auction block, it almost always creates a distraction effect. Resources and management focus are shifted away from growing sales and directed toward, packaging the unit for a potential buyer.
Right, which results in a temporary dip in performance.
Exactly.
So the core engine, aerospace, and industrial gas turbines is the real focus here, and that leads directly into the management commentary from the earnings call.
Yes, the CEO's comments were fascinating.
He used a very specific phrase to describe their current operating environment. He said they're in, quote, allocation mode.
Yeah, you rarely hear that phrase in heavy industrial manufacturing, and it tells you everything you need to know about their leverage in the market right now.
It makes me think of an air traffic controller dealing with way too many inbound flights, or like a high-end club operating at a one-in, one-out capacity. You can't just build another runway in 5 minutes to accommodate the rush. You have to meticulously calculate holding patterns, prioritize which planes get to land first based on strict long-term contracts.
That is DPC right now, down to a T.
Because the demand from their aerospace and energy customers is so high and their factory floor space is so limited that they are literally rationing their supply of superalloy components.
And the leverage they gain from being in that position is immense. I mean, when you are the air traffic controller in a congested sky, you dictate the terms.
Absolutely.
Management announced on the call that they are capitalizing on this massive backlog by signing their 4th strategic partnership with a major aerospace original equipment manufacturer.
And these are not just casual handshake agreements for surplus parts, right?
Not at all.
These are foundational, multi-year manufacturing contracts.
This latest partnership is so substantial that it actually underpins the construction of an entirely new superalloy facility currently being built down in Alabama.
Right, the Alabama plant.
Yeah. Management was explicit on the call. When you combine these 4 strategic partnerships, they represent over $200 million of incremental margin-accretive annual revenue that will hit its full run rate by 2029.
Okay, wait. If it's margin accretive, that means this new $200 million won't just puff up the top-line revenue.
Right.
It will actually increase their overall profit percentage because they are utilizing their allocation mode leverage to lock in highly favorable pricing terms.
You nailed it. They are essentially trading their current scarcity for long-term, guaranteed, highly profitable revenue streams.
Which brings us to the core conflict of this entire deep dive.
Here we go.
If demand is completely off the charts, if they have so much pricing power that they are rationing supply, and if they are locking in hundreds of millions in high-margin future revenue, why did institutional investors dump the stock? Why did it bleed out from a $54 pre-market high down to $50?
To find that answer, you have to bypass the income statement completely and go straight to the cash flow statement in the 10Q filing.
Yep.
The market didn't sell off because of the GAAP net loss or the IPO accounting noise.
Right, the algos know how to adjust for that.
Exactly. The market sold off because of a massive cash burn. Free cash flow for the first half of 2026 was a negative $53.8 million.
Wow. Just to put that in perspective for you listening, in the first half of last year, free cash flow was a positive $11 million.
Yeah.
So we are looking at a $64 million negative swing in actual cash generation.
And Wall Street loves a growth story, but they despise it when growth consumes every drop of liquidity in the business.
Yeah, truly.
There are 3 main culprits draining DPC's cash reserves right now, and they are all causally linked. The first is elevated capital expenditures, or CapEx.
Because they spent $19.8 million in CapEx just in this quarter alone.
Exactly.
Which logically makes sense. If you are operating in allocation mode and you need to build a brand new superalloy facility in Alabama to service this new OEM contract, you have to pay for the concrete, the steel, the advanced robotics today.
Right, the bill comes due now.
Even though that $200 million in revenue doesn't fully arrive until 2029.
And management explicitly guided that CapEx will remain elevated. and likely increase in 2027 as they continue to build out that physical capacity.
So the spending isn't stopping anytime soon.
No, the market is aggressively pricing in the fact that this infrastructure cash drain is going to persist for at least another 18 to 24 months.
Okay, so that's culprit number one. What's the second?
The second culprit draining cash is perhaps the most frustrating one for a manufacturing company to navigate: working capital and raw material inflation.
Right. The earnings call specifically flagged hafnium price inflation as a major headwind.
Hafnium is a highly specialized transition metal. It is an absolute necessity for the superalloys that DPC manufactures.
Because jet engines and industrial gas turbines run incredibly hot, right?
Exactly. Temperatures that would melt standard steel like butter.
So what does the hafnium do?
It acts as a stabilizing heat sink within the alloy, allowing the turbine blades to maintain their structural integrity at extreme temperatures.
So you literally cannot build these components without it.
You cannot. But the global supply chain for hafnium is opaque and highly volatile, and prices have spiked significantly.
But wait, if they have so much pricing power in allocation mode, why don't they just immediately raise the price of their finished turbine blades to cover the increased cost of the hafnium?
In these heavy industrial supply chains, long-term contracts include metal pass-through clauses, but there is a critical time lag.
Of course.
If the price of hafnium spikes today, DPC has to pay that inflated price immediately on the spot market to acquire the raw materials and keep their factory lines running.
But they can't charge their customers right away.
Exactly. Their contracts dictate that they cannot pass that cost increase onto the aerospace OEMs for 18 to 24 weeks.
So they are effectively acting as a temporary bank for their own customers.
That's exactly what it is.
They are forced to swallow the inflated costs of raw materials today, paying 2026 inflation prices to build the components, but getting paid 2025 contract rates for almost half a year until the clause resets.
And it acts as a massive drain on working capital. The revenue eventually catches up, which is partly why the top line looks so enormous this quarter.
Right.
But the cash flow takes a severe beating in the meantime as they absorb that inflation shock on behalf of their clients.
Man, if they are hemorrhaging working capital to act as a temporary bank and pouring millions into building new factories, that has to be tearing a hole in their short-term liquidity.
It really is.
How close to the edge are they? I mean, what is the third culprit?
If you look at their balance sheet at the end of Q2, their current ratio was sitting at 0.84.
Wait, a current ratio of 0.84?
Yeah.
Doesn't that mean they literally have less than $1 of liquid assets on hand for every dollar of short-term debt and obligations coming due over the next year?
Yes, it does.
That is a glaring red flag for an institutional risk manager.
It signals immediate near-term liquidity pressure. I mean, when an algorithmic trading program or an institutional risk desk sees negative $53 million in free cash flow, rising CapEx commitments, and a sub 1.0 current ratio, they hit the sell button.
Without hesitation.
It creates a narrative of financial fragility, regardless of how strong the underlying customer demand is.
Right, institutions look at that 0.84 ratio and wonder if DPC is going to be forced to issue more stock, diluting shareholders.
Or take on incredibly expensive short-term debt just to keep the factory lights on while they wait for the Alabama facility to be finished.
That perfectly explains the post-earnings panic and the massive sell-off.
It does.
But this is where the story gets really fascinating, because there is a massive divergence between what the retail market did in a panic and what the ultimate company insiders were doing with their own wallets.
Oh, this is the best part. Following the June 25th IPO, which priced at $33 a share, we saw aggressive multi-billion-dollar insider purchasing from the very executives who understand this cash flow dynamic better than anyone else on Wall Street.
And we are not talking about a couple of board members buying a few hundred shares for a PR stunt.
No, definitely not.
Chief Financial Officer David John Egan, the executive who is literally in charge of managing that 0.84 current ratio and the negative free cash flow, he went into the open market and bought over 275,000 shares.
Yep.
That is $9 million of his own personal capital.
And Director Nick Sanders followed suit, buying over 288,000 shares, which represents a $9.5 million purchase.
Incredible.
When the CFO and a key director dropped nearly $20 million of their own money into the stock at the $33 IPO price, it sends a definitive signal to the market.
They clearly view the current cash flow crunch as a temporary, manageable growing pain, not a systemic risk to the enterprise.
Exactly. They know the internal math. They know that $200 million in high-margin contract revenue is firmly locked in for 2029,
They know the Alabama facility is fully funded and will get built.
and they're comfortably looking past that 18-week hafnium pricing lag.
And looking at the analyst notes, it seems like Wall Street research desks are starting to align with the insiders rather than the algorithmic sellers.
The analyst community is clearly weighing the allocation mode demand heavier than the short-term working capital drain.
Which makes sense.
Despite the stock dropping to $50 on the cash flow concerns, RBC Capital initiated coverage on DPC with an outperform rating, setting a $53 price target that they subsequently raised to $62.
Oh, wow.
And Morgan Stanley also upgraded their view, raising their target from $47 up to $59.
Because they are modeling for the long-term organic growth that happens once these new factories actually come online.
Exactly.
So what does this all mean for you as an investor? It means DPC is a company caught in the incredibly messy transition phase between securing explosive future growth and paying the immediate heavy bill to actually deliver on it.
Right.
The revenue is real, the customer demand is real, but the cash required to build the infrastructure and buy the volatile raw metals is causing severe, albeit likely temporary, pain on their balance sheet.
And if we step back and look at the absolute macro picture, there is a final vital piece of context that wasn't heavily featured in the headline numbers, but is driving this entire long-term thesis.
Okay, what's that?
Well, while the 47% growth in the aerospace division gets all the glamorous headlines, because everyone understands the backlog of commercial airplanes, the industrial gas turbine segment, which grew 42%, is actually a hidden backdoor play on the artificial intelligence boom.
Wait, gas turbines and artificial intelligence.
Yeah.
How do physical heavy metal gas turbines connect to software and AI data centers?
Management noted on the earnings call that there are over 2 terawatts of industrial gas turbines installed globally right now that require ongoing maintenance and replacement parts.
2 terawatts.
To put 2 terawatts into perspective, that is roughly enough energy to power hundreds of millions of homes simultaneously.
That is mind-boggling.
And why does that matter for AI? Because generative AI data centers are demanding unprecedented astronomical amounts of grid electricity.
And solar and wind farms simply cannot provide the stable 24/7 baseload power required to run a massive server farm.
Right.
You cannot have a multi-billion-dollar AI cluster go offline and lose days of computing power just because it's a cloudy day or the wind stops blowing.
Precisely. The global power grid is being forced to rely heavily on natural gas turbines to bridge the gap and keep these AI servers from going dark.
Wow.
Natural gas provides the constant, unwavering baseload power that tech giants require. But to meet this new AI demand, those gas turbines are being forced to run harder, hotter, and longer than they ever were originally designed to.
And when a turbine runs hotter and longer, the physical parts wear out exponentially faster.
They endure massive thermal fatigue, and when they need to be repaired, they require the exact high-precision, hafnium-laced, heat-resistant superalloy components that DPC manufactures.
So it all comes full circle.
It does. As the AI revolution accelerates, the collateral demand for reliable grid electricity will push these turbines to their absolute physical limits.
Meaning, DPC's aftermarket parts division isn't just looking at a good year or two.
No, they could be looking at a massive, sustained supercycle of demand for replacement parts that lasts for a decade or more.
So the next time you see a headline about a tech giant building a massive new AI data center, don't just think about the expensive computer chips inside the building. Think about the physical spinning metal turbines miles away, generating the electricity to power them, and the congested supply chain desperately rationing the replacement parts to keep them spinning. Make sure to follow the show for daily, no-nonsense earnings coverage just like this to help you find the signal in the noise.